Before the wheel was refined, before the alphabet existed, before any civilization had produced a single line of literature, a human being sat down and produced what we would recognize today as a financial statement, and that decision changed everything. The year was approximately 3300 BCE. The place was Uruk, a city in southern Mesopotamia in what is now Iraq. A temple administrator pressed a reed stylus into wet clay and recorded the distribution of barley rations to workers. That tablet, now catalogued as item 327385 at the Metropolitan Museum of Art, represents the oldest known financial record in human history. Here is what your history teacher never told you. Writing was not invented to compose poetry. It was not invented to record prayers or chronicle the deeds of kings. Writing was invented to produce financial statements. The pictographic symbols on those Uruk tablets, confirmed by University of Texas archaeologist Denise Schmont-Besserat in her 1992 study before writing, were accounting marks, grain quantities, livestock counts, temple revenues. The implication rewrites everything you thought you knew about civilization. Humans did not become literate and then decide to track their finances. Humans needed to track finances so badly that they invented literacy to do it. The financial statement came first. Everything else, every poem, every scripture, every law code, every love letter, every novel you have ever read, is a derivative application of a technology created for accounting. People assume money runs the world. That is the surface story. Money is the visible layer. Underneath money sits something older and more powerful. The system that records money, allocates it, and proves where it went. The financial statement. This is not a story about numbers on a page. This is a story about control. About how the ability to produce, read, and manipulate financial records has determined which empires rose, which corporations dominated, and which economies collapsed into dust. Welcome to Noob Historian. We follow the money, trace the power, and expose the history they never taught you in school. You live inside a system built on financial statements. Your mortgage is a financial statement. Your tax return is a financial statement. The quarterly report that determines whether your employer lays off your department is a financial statement. The ability to read these documents, to understand what they hide as much as what they reveal, is the difference between those who control wealth and those controlled by it. 5,000 years ago, a temple administrator in Uruk understood this. Today, you will too. For nearly 3,000 years after those Uruk tablets, financial record-keeping remained primitive. Merchants across the Mediterranean, the Silk Road, and the trading posts of medieval Europe kept single-entry records. They wrote down what came in, they wrote down what went out. But they had no systematic method to verify accuracy, detect theft, or produce a comprehensive picture of financial position. Then, in the merchant houses of medieval Italy, something changed. By the 13th century, Venetian and Florentine traders had developed a method so powerful it would become the invisible engine of Western capitalism. They called it the method of Venice. We call it double-entry bookkeeping. The principle was elegant. Every financial transaction affects two accounts. When you buy inventory, your cash account decreases and your inventory account increases. When a customer pays you, your accounts receivable decreases and your cash increases. Both entries must balance. If they do not, something is wrong. Someone made an error, or someone is stealing. For 200 years, this method remained the proprietary advantage of Italian merchant families. The Medici used it to build a banking empire that financed popes and kings. Venetian traders used it to dominate Mediterranean commerce. The method was so valuable that families guarded it as a trade secret. In 1494, a Franciscan friar named Luca Pacioli published a mathematics textbook in Venice titled Summa de Arithmetica, Geometria, Proporzioni et Proporzionalità. Buried within its 615 pages was a 27-page section called Particularis de Computis et Scripturis. This section, for the first time in history, explained double-entry bookkeeping to anyone who could read. Pacioli did not invent the system, he documented it. And in doing so, he detonated an information bomb across Europe. Within decades, the method spread from Italy to the counting houses of Antwerp, the trading companies of Amsterdam, and the merchant guilds of London. Stephen Toms, in his 2010 paper in the Accounting History Review titled Double Entry and the Rise of Capitalism, traced a direct causal link between the spread of balance sheet methodology and the emergence of modern capital markets. Here is why the link matters. Before double-entry bookkeeping, investing in a business required personal trust. You had to know the merchant. You had to believe his word when he told you the venture was profitable. There was no independent way to verify. Double entry changed that equation. A properly maintained set of books could be audited. An outside party could examine the ledger and confirm whether the entries balanced. For the first time, financial statements could substitute for personal trust. This made large-scale investment possible. A merchant in Amsterdam could invest in a trading voyage to Indonesia without personally knowing the ship captain. A banker in London could finance a sugar plantation in Barbados without visiting the Caribbean. The financial statement became a trust-generating machine. By 1600, the Dutch East India Company issued stock certificates to outside investors and published financial reports. It became the first multinational corporation and, at its peak, was worth more in inflation-adjusted terms than Apple, Google, and Amazon combined. None of this was possible without the balance sheet. The Venetians did not conquer through military might. They did not possess natural resources or a vast population. They possessed a technology for recording financial reality with precision. That technology, once released into the wild, rebuilt the economic order of the entire planet. You use the same technology today. Every corporation on the New York Stock Exchange files quarterly balance sheets with the Securities and Exchange Commission. Every small business owner who applies for a loan submits financial statements to a bank. The system is so embedded in modern commerce that we forget it was invented. We forget that, for most of human history, it did not exist. And we forget what happens when it gets corrupted. The year was 1720. The place was London. And the financial world was about to learn what happens when financial statements lie. The South Sea Company had been granted a monopoly on British trade with South America in 1711. The company made grand promises about the riches awaiting shareholders: gold from Peru, silver from Mexico, exotic goods from across the Spanish colonies. There was one problem. Spain controlled South America and had no intention of letting British merchants operate freely in its territories. The South Sea Company's trading operations were minimal, its actual revenues were negligible, but its stock price was soaring. In January 1720, South Sea shares traded at £128. By June, they reached £1,050. Members of Parliament bought shares. The royal family bought shares. Isaac Newton, one of the greatest minds in human history, bought shares, sold them for a profit, then bought again at higher prices. The company's directors had engineered this rise through a combination of bribery, stock manipulation, and fraudulent financial disclosure. They loaned money to investors to buy company shares, inflating demand. They issued false subscriber lists, making it appear that wealthy aristocrats were clamoring to invest. And they published financial statements that bore little resemblance to economic reality. By September, the bubble collapsed. Shares fell to £150. Fortunes evaporated overnight. Newton lost £20,000, equivalent to several $1,000,000 today. He reportedly said he could calculate the motions of heavenly bodies, but not the madness of men. Parliament launched an investigation. For the first time in recorded history, an external auditor, Charles Snell, was hired to examine a company's books and report findings to a legislative body. The investigation, documented in the Journals of the House of Commons, Volume 19, revealed the full scope of the fraud. The company's transfer books had been falsified. Directors had backdated transactions to conceal insider dealing. Financial statements had been engineered to deceive. 3 company directors were arrested. The Chancellor of the Exchequer was expelled from Parliament and imprisoned in the Tower of London. The government passed the Bubble Act of 1720, restricting the formation of joint stock companies for the next century. The South Sea Bubble became the founding case study in financial fraud. It demonstrated with devastating clarity that financial statements are not neutral documents. They are instruments of power. In the wrong hands, they become instruments of theft. Gary Giroux, in his 2013 study Detecting Fraud in Organizations, traced the direct lineage from the 1721 parliamentary investigation to modern securities regulation. The requirement that public companies file audited financial statements with government regulators, the cornerstone of modern investor protection, was born from this scandal. But the lesson was not learned permanently. The same fundamental manipulation would occur again and again and again. Fast forward 281 years. The year is now 2001. The company is Enron Corporation, headquartered in Houston, Texas, and the mechanism of destruction is identical to 1720. Enron was not a traditional energy company. It had transformed itself into an energy trading operation, buying and selling contracts for future delivery of natural gas, electricity, and other commodities. By 2000, it reported revenues of $101 billion, making it the 7th largest company in America by revenue. Fortune magazine named Enron the most innovative company in America for 6 consecutive years. Its stock was a Wall Street favorite. Its executives appeared on magazine covers. Business schools taught the Enron model as the future of corporate enterprise. The entire edifice was a fraud. At the center of the deception sat a single accounting technique, mark-to-market accounting. This method, approved by the SEC for Enron's trading operations, allowed the company to record the projected future value of long-term contracts as current revenue. If Enron signed a 20-year energy supply contract, it could book the estimated profit from all 20 years immediately. The problem was obvious. Those projections could be manipulated. And they were. Enron executives inflated revenue projections. They created off-balance sheet partnerships with names like LJM and Raptor that concealed billions in debt. They sold assets to these partnerships and booked the transactions as sales, generating artificial profits. When the partnerships needed cash to stay afloat, Enron quietly funneled money back to them. The Powers Report, released in February 2002 by a special committee of Enron's own board, documented the scheme in forensic detail. Chief Financial Officer Andrew Fastow had personally enriched himself by more than $45 million through these partnerships. Other executives had pocketed tens of millions more. But the financial statements filed with the SEC showed none of this. The balance sheet showed a healthy company. The income statement showed growing profits. The cash flow statement showed robust operations. All of it was false. In October 2001, Enron disclosed that it had overstated earnings by $586 million over the previous 4 years. The stock price, which had traded above $90 in 2000, collapsed. By December, the company filed for bankruptcy. At the time, it was the largest bankruptcy in American history. 20,000 employees lost their jobs. Many lost their retirement savings, held in Enron stock through the company's 401k plan. Shareholders lost $74 billion in market value. Arthur Andersen, the accounting firm that had audited Enron's financial statements and certified their accuracy, was convicted of obstruction of justice for shredding documents. The firm, one of the big 5 accounting companies, dissolved. 85,000 employees worldwide lost their jobs, not because of what they did, but because their employer had certified false financial statements. The Enron collapse triggered the Sarbanes-Oxley Act of 2002, the most significant reform of securities regulation since the Great Depression. The law required CEO and CFO personal certification of financial statements, created the Public Company Accounting Oversight Board to regulate auditors, and imposed criminal penalties for securities fraud. Congress was responding to the same problem Parliament had addressed in 1721. Financial statements had been manipulated to deceive investors. The economy had suffered. Legislators scrambled to prevent recurrence, but the pattern would continue. Enron was not an isolated case. Within months of its collapse, an even larger fraud surfaced at WorldCom, the telecommunications giant. WorldCom had grown through aggressive acquisitions throughout the 1990s, becoming the second largest long-distance carrier in the United States. Its CEO, Bernard Ebbers, was celebrated as a visionary who had built a telecom empire from a small Mississippi reseller. The empire was built on fraudulent financial statements. WorldCom's core fraud was simpler than Enron's, but equally devastating. The company took billions of dollars in ordinary operating expenses, costs like line rental fees paid to local phone companies, and reclassified them as capital expenditures. The single accounting maneuver transformed current expenses into assets that could be depreciated over years. The effect on the income statement was dramatic. Operating expenses disappeared, profits appeared. Investors saw a healthy, growing company. The SEC investigation, documented in filings available in the EDGAR database, revealed $3.8 billion in fraudulent capitalized expenses. Later restatements would identify total accounting fraud exceeding $11 billion when WorldCom filed for bankruptcy in July 2002. At $107 billion in assets, it surpassed Enron as the largest bankruptcy in American history. That record stood until the 2008 financial crisis. Bernard Ebbers was convicted of securities fraud and sentenced to 25 years in federal prison. He died in 2020, shortly after receiving a compassionate release. The combined destruction from Enron and WorldCom exceeded $140 billion in lost market value. Pension funds, insurance companies, and individual investors had relied on audited financial statements to make investment decisions. Those statements had lied. The losses were real. What connects a clay tablet from 3300 BCE Uruk to a Houston bankruptcy court in 2001? The same fundamental truth. Financial statements are not passive records. They are active instruments that shape economic behavior. When accurate, they enable trust, investment, and growth. When false, they enable theft, collapse, and destruction. The technology has grown more sophisticated. The numbers have grown larger, but the mechanism has not changed in 5,000 years. The pattern continues into the present day. Between 2020 and 2022, the United States Congress passed the Holding Foreign Companies Accountable Act. The law addressed a specific problem. American regulators could not verify the accuracy of financial statements filed by Chinese companies listed on American stock exchanges. Under Chinese law, audit work papers for Chinese companies were considered state secrets. American auditors could conduct audits, but they could not share their findings with the Public Company Accounting Oversight Board. The PCAOB could not inspect the audits. American investors were being asked to trust financial statements they had no way to verify. The parallel to 1720 is precise. The South Sea Company's directors manipulated financial records because no external party had the authority to examine them. Chinese companies listed in New York operated under the same structural advantage. Their financial statements could say whatever they wanted. No American regulator could confirm or deny. The 2022 law required Chinese companies to permit PCAOB inspection or face delisting from American exchanges. After months of negotiation, China permitted inspections to proceed. The alternative was losing access to American capital markets entirely. But the underlying tension remains unresolved. Financial statements serve two masters. On one side, they function as economic measurements, capturing revenues, expenses, assets, and liabilities with precision. On the other side, they function as narratives, telling a story about a company's health, its prospects, and its value. When the measurement function dominates, financial statements generate trust. When the narrative function dominates, financial statements generate manipulation. The rise of ESG reporting, environmental, social, and governance disclosures, introduces this tension in a new form. Companies now publish extensive reports on carbon emissions, workforce diversity, and supply chain ethics. These reports carry the visual appearance of financial statements. They include numbers, tables, and auditor attestations. But the measurement frameworks are new and inconsistent. One company's carbon calculation differs from another's. Social impact metrics lack standardized definitions. The opportunity for narrative manipulation exceeds anything possible with traditional financial statements. Investors who understand the historical pattern will recognize the warning signs. Financial statements are most dangerous when they are newest. The Sumerian clay tablets took centuries to standardize. Double-entry bookkeeping took centuries more. Each new category of financial disclosure passes through a period of vulnerability before standards mature and verification mechanisms develop. You are living through such a period now. The accountant in Uruk, who pressed symbols into clay, could not have imagined the world that decision would create. The Venetian merchants who balanced their ledgers could not have foreseen trillion-dollar corporations. The parliamentary investigators who examined the South Sea Company's books could not have predicted global securities regulation. But each of these actors operated within the same system you inhabit today. Your mortgage application requires financial statements. Your employer's survival depends on financial statements. Your retirement account holds stocks valued by financial statements. The government bonds that back your currency are accounted for in financial statements. The banks that hold your money are regulated through financial statements. There is no exit from this system. There is only understanding. The civilizations that mastered financial recording accumulated surplus, financed expansion, and dominated competitors. The corporations that manipulated financial statements extracted wealth until the deception collapsed. The regulators who demanded transparency protected markets. The regulators who failed enabled fraud. This pattern will not change in your lifetime. The technology will evolve. Digital ledgers and blockchain systems will introduce new recording mechanisms. Artificial intelligence will analyze financial data at speeds no human can match. But the fundamental dynamic, the tension between accurate measurement and narrative manipulation, will persist. Your advantage lies in seeing what others miss. Most viewers of financial news see headlines about stock prices and earnings reports. They see the surface numbers. You now see the 5,000-year infrastructure beneath those numbers. You see that writing itself was invented for financial accounting. You see that modern capitalism was enabled by double-entry bookkeeping. You see that every major financial fraud follows the same pattern of statement manipulation. This knowledge does not guarantee wealth, but it prevents a specific form of poverty. The poverty of being manipulated by documents you do not understand. The ledger opened in Uruk 5,000 years ago. It has recorded the rise and fall of empires, the birth of corporations, the destruction of fortunes. Every transaction leaves a trace. Every manipulation eventually surfaces. Every fraud has its reckoning. The ledger never closes. It only adds entries. And now you can read it.